Taxes, taxes, taxes. Aloha, I'm Malia Zimmerman, and today we have one of the top experts in the state, if not the top expert in the state, on Hawaii's taxes. And what this means to you? Well, it affects your pocketbook. So stay tuned to this next half-hour show with Lowell Kalapa, President of the Tax Foundation of Hawaii. Lowell, thank you for coming today.
It's my pleasure, and enjoy coming back and visiting with you.
Good. Okay. Well, tell us about this last legislative session for people who might not have followed it too closely. There was a lot of implications for taxpayers and
for
how
taxpayers, for
right.
businesses in our state, for the families of our community. There were subtle, if not hidden, tax increases adopted by the legislature as a means to balance the state budget. And unfortunately, these are subtle increases to the point people won't recognize them as tax increases until it's almost too late. And we're talking about, for example, the administration itself proposed tax increases in the form of taking away the deduction of state income and sales taxes, both for families as well as for businesses. And while they argued that, the feds don't allow us to deduct federal withheld taxes, why should the state? They failed to recognize that, first of all, we try to conform to the federal law to maintain a conformity that simplifies the administration and compliance of the income tax. The second thing is, for businesses especially, taxes are a cost. It's a cost that affects the bottom line. So when the bottom line is affected, it shrinks, and so therefore they have less capital available at the end of the day to expand their businesses, create another job, put out more product. So that's an increase that will weigh heavily on not only businesses, but also on employees as we look and search for more and more jobs for our people. They also propose getting rid of itemized deductions for higher income individuals by limiting it to specific dollar amounts. And they pointed to the fact that the federal code had this limitation on itemized deductions for higher income people. What they failed to say is that Congress realized that it actually was detrimental because it discouraged high-income individuals from, for example, increasing their charitable deductions. So it didn't affect the high-income people as much as it affected the charities that depend on the generosity of taxpayers to make charitable contributions. And in fact, they sunset that provision at the federal level in 2009. So we're kind of making the same mistake that Congress made several years ago and then realized it was a mistake. At the legislative level, they got rid of so-called exemptions from the general excise tax, and I would like to call them certain treatments of income. And one of the worst things they did was to suspend the exemption on stevedoring activities. As you all know, we all know that, almost 98% of what we consume in goods comes over our docks, either from the mainland or from other islands. That has been exempt from the 4%. That activity of loading and unloading ships as well as airplanes has been exempt from the general excise tax until this bill passed. And if it becomes law on July 1st, the cost of everything will go up. So the cost.
Yeah. So what about airlines? You're talking about exemptions, where the airlines were also lost their exemption as well, right? Can you talk about that?
As we all know, we can't get from one state to the other by driving our cars. We have to take, some kind of transportation, and because of efficiency, it's going to be an airplane. A lot of the local airlines, instead of buying their capital equipment or their jets or engines or whatever, they lease them, and that lease has been exempt from the general excise tax. So now we add it back in, it's going to be 4% more expensive for an airline like Hawaiian Airlines or even Go Mokulele. Anybody who is domiciled here in the state and leases their aircraft equipment or engines or whatever, or parts, they're going to pay a 4% tax on that lease income that goes to somebody else outside the state or inside the state. So the cost of your airline tickets will go up. And so that's another subtle increase that'll occur. And probably the one that has gotten the loudest pushback in the construction industry is the deduction for payments made by a general contractor general contractor to a subcontractor.
Now, this is going to impact the cost of housing and construction of buildings
Construction
and everything,
in
right?
general.
In general.
Yeah, in
So
general.
even government projects. And
Even
everything.
government projects will go up, and so instead of saving money or getting more money to run government will become more expensive to run because the contractor, under this provision, was able to exclude the amount that he paid to a subcontractor. And as we know, because of our state laws governing construction, there are so many specialty contractors that are not, you have to go to, if you don't have that particular expertise within your general contractor's company, you've got to pick up a subcontractor to do that work. So, remodeling your kitchen, you may have a subcontractor who does only countertops, or a subcontractor who only does floor tile, or a subcontractor that does only the cabinets. And so what it'll do is increase the cost of your kitchen remodeling or renovation, or it'll be a heyday for accountants as they try to figure out a structure where you can avoid having to pay the 4% twice. And let me just explain. So say your project costs $100,000, and the general is going to charge you out of that $100,000, maybe $50,000. He's got 5 specialty contractors on him. So he'll receive the $100,000 and pay 4% on the entire thing, and then turn over $10,000 to each to the 5 subcontractors. They in turn will pay another 4% on that $10,000. So $50,000 of that may be taxed as much as twice, if not more, at the 4% rate.
Now, one of the questions was, okay, this is supposed to start July 1st, right?
Correct.
Now, what if you've already signed a contract before July 1st? Does it matter? I mean, how does that impact? Does anybody know that yet?
Those contracts are not grandfathered in.
Okay.
There is no provision within the bill that says, oh, if you already had a contract, this ain't going to apply to you. I'm sorry, it's going to apply when the gross income is received.
Okay.
And unless we hear otherwise from the tax department, that's the way I think we interpret the law, the new law. So it is going to raise that. The other big one is sales to the federal government. Sales to the federal government are preempted by federal law, technically. But because we don't have a sales tax, we have a gross income tax on the vendor, we needed the exemption within the general excise tax to prevent the vendor being subject to the 4% tax. With the suspension of that exemption, sales to the federal government may not show out a sales tax because they are preempted by federal law, but the vendor is going to be subject to paying 4% on the gross income from the sale of those goods to the federal government. So he either will have to increase the cost of his goods to accommodate the 4%, or have to pay that 4% out of his pocket. And I think the latter case will not happen because he'll go out of business. So the cost of even sales to the federal government, or many people don't know, for example, their credit unions are considered instrumentalities or a part of the federal government and have enjoyed this exemption for years. So the cost to the credit unions will go up because all of their purchases of goods is going to be subject to 4% or an additional 4% cost. And so the returns to, say, the depositors at your local credit union is going to shrink because now more of it will go in the form of general excise taxes.
So what if you have, how does this all impact jobs? You have the cost of everything going up, people are paying more taxes, and we can talk about 2 things, the economic recovery coming up, and what do we see with jobs? I mean, I know as an employer myself, if my costs go up, I can't employ more people.
If your bottom line shrinks, your profit shrinks, you don't have the capability, the financial capability to create another job. So at a time when we need the addition of jobs, the state legislature basically has taken actions that will shrink the ability of the private sector to create jobs. And this is why those pieces of legislation just don't make any sense as we struggle to recover from the economic recession that we've just witnessed in the last few years.
So why do you think the legislature does this? I mean, they do this every year. We see these tax increases going through. They make it harder for businesses to do business. Why is that?
I think it's even more difficult for them to tell their constituents no. So they respond in a Pavlovian manner to demands for this service or that service. And many of the services that were added during times of plenty, in times when we had huge surpluses, have become entitlements to the constituents. So they say, well, we deserve to have this service without realizing that we now don't have the money to pay for those services and that we may have to cut back. So as we saw the other day in the newspaper, the fact that we have to cut about $8 million out of pupil classroom expenditures, how do you make it up? And I think this is where it's a challenge to state government, both legislators and administrators, to use a little bit more creative thinking, if you're decision-making thinking, that will be able to provide service, the level of services at a more efficient cost. So, for example, I think the other day, for example, the economic development director called on the private sector to step to the plate, if you will, and help diversify the economy of the state for the future prosperity of our families and our businesses here in Hawaii. And I think he fails to realize that a good part of the problem is the hurdles that state government creates, state and county government creates for businesses to expand. So one of them is the higher burden of taxes.
Right.
The other burden that can be considered a tax but isn't called a tax is the regulatory atmosphere here in the state. Anybody who has applied, for example, to set up a brand new business will tell you about the paperwork that's involved, the number of steps and approvals they have to secure. The permitting process for buildings is notorious.
Right.
And that just doesn't help because that adds to the cost of creating a job or opening up a new business. So if you want to talk about the atmosphere for creating jobs and businesses here in Hawaii, it's pretty poor.
That brings up another subject, but before I get to that, about the new studies that just came out, you were talking just a minute ago about the economic development director who said that it was basically $10 million, right? The state got $10 million, and they wanted the private sector to jump up and say, hey, well, I'll put in what, 130 million or something like that, right?
Something like that.
Right.
But the question is that money well spent when most of it is going to futile actions? In other words,
Right.
like redundancies in trying to deal with the laws of the state. If there's nothing else that the government can do at this point is to look at their own backyard, to see how they can streamline while preserving the integrity of the measures that have been enacted to ensure the safety and health of our community. There's got to be a better way to do it because right now, the way they're doing it costs businesses, costs jobs in our economy. So we cannot look forward to prosperity for our community if, in fact, so much of the cost of providing that prosperity and expansion in the future is being taken up because of government regulations and government taxes.
Well, there's so many studies that back you up. In fact, one study that just came out this week says Hawaii is the 43rd worst place to do business. And that's actually pretty good because we've been rated the worst place to do business before, right? The 50th, the 50th best or the absolute worst place. And we see that over and over again with these rankings coming out where we're almost always at the bottom, unless it's for something like health or sunshine or longevity. Somehow we live long with all these with all these taxes, which might make it worse. But what about the economy? Okay, we just saw the Economic Council, the Council on Revenues, say that, well, they were asked to come back by the governor, I think, and determine whether or not the economy is going to be worse because of the tsunami from Japan and affecting tourism and on and on and on. And basically they said, no, everything's going to stay the same. We're not changing anything. And because of that, there was no special session called. So the legislature didn't have to come back into emergency session, readjust the budget, and so on. So what do you think about that? Do you think that our economy is going to be a minus 1.2% growth?
1.6.
1.6% growth.
Growth in tax revenues for this current fiscal year.
Yeah.
As you know, Malia, just this other day, the governor indicated, or the budget chief indicated that the state may have to dip into the hurricane fund in order to keep the doors of state government open through the end of this fiscal year. And if that's the case, then the minus 1.6 is not going to materialize. It's telling me that they themselves don't expect the money to materialize enough to balance the budget for this year, because that's what the legislature supposedly did, was to make the cuts necessary so it fell within the minus 1.6. So I don't think that forecast is going to materialize. I think there was an awful lot of pressure not to call a special session. because the legislature didn't want to deal with it anymore. They figured it's up to the administration to do it. And I was gratified to see our former governor point out he did what he had to do when there was no money, and that was to sit down and work with all parties, including the unions, to work out ways to ensure that services continued with what resources were available. And perhaps maybe that's the message that the legislature is sending back to the administration is make do with what you got. You're the guys that are in the driver's seat. You know, we give you a budget, and if there's not enough money, then it's up to you to decide where to cut. And maybe rightfully so, because we have to remember lawmakers are public policy makers. They're not executioners of the policy. And it is the administration that must execute the policy set by the legislature. And if there aren't enough resources, then the administration has to react by saying, we're going to set priorities for these programs, or we're going to change how we deliver these services through these programs so that we can make the best use of the tax dollars that are available to us. And I think perhaps that's what we should remember as we move into the new fiscal year, and perhaps really not have the money to pay the bills.
So the Council on Revenue said for the future that we're going to have this seemingly big growth spurt. I mean, it sounded like they were arguing back and forth in the meeting about what it was going to really be between, I think it was 8% and 13%, and then they settled on 11, okay.
11 for the next
fiscal year. Okay.
Right.
So what was that all about? Do you think that
well,
we're really going to grow
Their
that
rationale
much?
is that, you know, this year was so bad that any kind of growth is going to be ebullient. It's going to just burst out all over, and that 11% is not unreasonable from the standpoint that, you know, we talk about it in statistics class all the time. You know, you can have 100% growth when you increase your employees from 1 to 2.
Right.
So it's their kind of, I think, their logic, if you will, that, you know, revenues are going to return not as high as they were in our best years, but they're going to return from a very negative situation because of what happened in the last 2 years, and then the shifting of the net income tax refunds and all of that. So the water is very murky, and they feel that, you know, the result is that we're going to have economic recovery that's going to produce revenues that will look like they're substantially better next year, to the point where they're talking about a double-digit bounce in 2012.
Okay, so now we're talking about, you mentioned the Hurricane Relief Fund getting rated. We had a lot of special funds rated, but the Hurricane Relief Fund, that was set up to back the insurers, right? In case there was a hurricane again, because when the insurers left the market, we needed something to help.
It provided an emergency savings account, if you will, and all of us paid into it. All of us as homeowners paid into this because the insurers left the market. There was no way to build up a reserve should another hurricane occur because they weren't providing that insurance out of the private sector. And so that's what that was supposed to be for, as a standby should another incident or disaster, natural disaster occur, and to step in should the insurers leave the market again. The question now is, if we're due for a hurricane and they have sapped the hurricane fund, where do we turn to? Right? And part of the response has been, well, you know, we gave them authority to issue bonds. The question is, what will the bond market react when they say, oh, they're coming to market and they're coming out because they're coming out of this disaster and they need all this money to repair the infrastructure or help people with their houses, but what's the prospects that they're going to have an economy that will produce the revenues that will be needed to pay off basically the debt service? And it just doesn't make a lot of sense. If you're coming out of a huge disaster, $1 billion, say, cleanup tab, and you're going to market with bonds, where's your economy? Because that's what the bondholder or the bond buyer is going to look at, is what is the promise or the expectation of the repayment of the money I'm loaning? And if you have no economy because, you know, everything's blown away, then that bond buyer is going to say, I want I want more for my money. I want a higher interest rate.
Right.
Because I don't know what the prospects are of getting paid back anytime soon.
Now, I want to get more into the bond raters, but I want to ask you quickly. Okay, so they rated, I think it's 46 million they're going to raid for this year, right, to close this fiscal year. But then Senator Jill Takuda said that they were also going to raid 60 million more in 2012 and 60 million more in 2013 for education. And I don't know if you followed that. So that I don't know if that means that it'll be 120 million plus the 46 million that's gone.
Well, there's about 130, 40 million in the hurricane fund. So if in fact it's all coming out of the hurricane fund, then there'll be nothing left.
Right.
Okay. There's hardly anything left in the rainy day fund after this bill that basically takes money from the rainy day fund is affected. If they take that money, then we have no reserves, really.
So now Moody's just came out. I wrote about this. Moody's just came out and downgraded Hawaii's bond rating.
Correct.
And so they said, basically for all the reasons you've been talking about, they gave those reasons for the downgrade.
Right.
And that means that we have a higher interest rate when we want to borrow in the future,
Go
right?
to market, we're going to pay higher interest rates.
We're going to pay higher interest rates. And then we're still, from what I heard from the budget director, we're still pending hearing from Fitch, which is another bond rater. And I guess Standard & Poor's kept us the same because the state's actually doing a lot of behind-the-scenes lobbying to try to get Fitch not to lower their rating and actually tried to get Moody's to talk about a stable outlook rather than a not a stable outlook, but maybe you could talk more about that.
Well, I think it's much akin to the debt ceiling at the federal level, debt limit at the federal level. Yeah, we may need to raise it just to cover our debts, the money that we need to borrow to operate. But if it doesn't come with a game plan, if you will, to correct our spending habits, then raising that debt limit doesn't do much long-term good. People will begin to be very cynical about lending money to the United States, or in this case, lending money to the state of Hawaii, if we can't bring our spending into control. And the outlook in the long term is that we will continue to need to borrow money in order to, in the case of the federal government, to pay for operating the federal government. And in the state of Hawaii, we can't raise our debt limit because we have none. We can't print money. So if we don't correct our spending habits, our free spending habits, then the prospect of raising taxes in the future becomes very real. And once you continue on down that road, it becomes even more difficult to exist in Hawaii. Let me call it existence, both for families as well as for businesses.
Now, the GO bonds are general obligation bonds, and that's what we got downgraded on, right?
That's correct.
And so that means when we want to build projects, that it's going to cost us more in the long run, right?
Correct. And there are three types of bonds. There are non-reimbursable general obligation bonds, which are backed by the full faith and credit of the state and the tax revenues that we generate. There are reimbursable general obligations, which are tied to a project or a facility. So, for example, we've used them for affordable housing, the Hula May bonds. And we expect, based on the project, that it's going to generate enough revenues. But it's still, if they default and the project not being able to pay, then it falls back onto the general fund to make those payments. And then finally, there are revenue bonds where there's a much more strict covenant that says this project has to pay for the debt service. The full faith and credit of the state doesn't stand behind it. It's the project that stands behind that. And so you've got to crunch the numbers to make sure that you will see a revenue stream that will be sufficient to cover the revenue bond debt service. So it's those reimbursable as well as those non-reimbursable general obligation bonds, which are of concern at this point because it's the full faith and credit of the state that guarantees those bonds. And if we cannot demonstrate that we're capable of generating sufficient revenues, and people have to remember, debt service is always the first charge against our general fund revenues. We have to pay off our mortgage before we pay for anything else, be it teachers' salaries or repairs to the schools, whatever. We have to pay our debt service first.
So, some people have said that because Hawaii's homeless population is growing, and I know one of your big issues is housing, public housing and housing in general. Do you see a correlation between taxes going up, cost of living going up, and more people becoming homeless or needing affordable housing?
You know, the reason we have such a large homeless population is the fact that people can't afford housing. Now, there are some people in the homeless population that are physically or mentally challenged. They are substance abusers, whatever, but there's a good part of that homeless population that just basically can't afford to either buy their home or rent their shelter. And that's a growing population because the cost of housing is becoming more and more expensive. It's, you know, a combination of factors. It's not just taxes, but it's also the fact that, you know, our land use policy has restricted the amount of land in the state that is zoned urban, that is, that you can build on it, to almost less than 4%. And so when you only have 4% of the land area that you can develop, then what's left to develop becomes very, very expensive because, you know, it's the law of supply and demand. So, you know, that will always be with us, and I think that the solution to the housing problem really goes back to having some very, very broad decisions made about where we develop, how we develop, and what we want our state to look like. And there is nothing wrong with preserving the natural beauty of the state, but we also have to recognize that what land is zoned urban needs to be maximized to its highest if we're going to provide sufficient housing.
Well, we only have about a minute left in the show, but tell me your crystal ball forecast for what's coming up. This may be for the economy and also for the legislature next year.
Woolworth went out of business, so that's where I got my crystal ball. So I don't know how that's
shucks.
good. I really do think that we are going to recover, but it's going to be a long, long road. As you know, at the national level, we look like we may be going into a double-dip recession. Job growth is not very apparent, and if that's the case, then our economy here in Hawaii, which is dependent on discretionary expenditures because of the visitor industry, will suffer as well. So the long-term outlook, if the national economy doesn't recover, regardless of what happened in Japan, we are not going to see a return to economic prosperity in the very near future. So, you know, we do have some major conferences. APEC is coming up. The meeting planners are here this next week. So yeah, there is some activity, but I think government needs to rethink, both state and county needs to rethink its role in actually creating an environment that will support economic recovery.
That was right down to the second. Perfect ending. Thank you so much. We'll have to have you on the show again. Thank you for joining us today. You heard all there is to know, and we'll have to do part 2 of the show on taxes in Hawaii. Thank you for joining us. I'm Aaliyah Zimmerman. Aloha.